Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. For the broader market, here's the view on Wall Street this morning. Andrew Sheets of Morgan Stanley writing lowering interest rates into easy financial conditions raises the odds of a more speculative boom if growth does not weaken. Andrew joins us now for more. Andrew, let's talk about what that means for credit. Multi-decade tights on investment grade, high yield near the tights of the year. Andrew, are we starting to see that speculative move start to build?
Yeah, thanks. Good morning. So, look, I think you are starting to see early signs of it. And again, the Fed has a difficult job. The Fed's in a difficult position. But it's certainly taking a risk by lowering interest rates and saying it's still going to lower them further, despite inflation being above its target, other measures of growth holding up, large government deficits, and I think importantly, some very easy financial conditions. As you mentioned, spreads are near multi-decade tights, equity valuations are near multi-decade highs. And I think importantly, we're starting to see M&A activity really pick up. We're seeing IPO activity pick up. We're seeing more signs of corporate confidence. So while those levels are still low by historical standards, they're certainly moving towards more activity. And that's a trend we think continues.
How does that square, Andrew, with the idea that we've gotten some negative economic news in terms of the non-farm payrolls report, some of the jobless claims data, albeit somewhat noisy? Does bad news equals bad news when you start seeing a deteriorating labor market?
Yeah, so I think this is what's so fascinating about the data at the moment is that you do see in labor market data and some other kind of traditional early cycle indicators, you really do see some weakness, everything from the jobs market to heavy truck sales. But you also see some other data that looks a lot better. GDP tracking measures are holding up. Retail sales have held up. And I think a really interesting one is if you look at commercial bank loan growth in the U.S., which is, kind of one of our favorite credit cycle indicators to follow, it's accelerating higher. And that's before we get, the expected deregulation of the banking sector, which we think is coming. So, I think the Fed is taking the view that, look, usually the labor market is the most important cycle indicators, the most important driver of recessions. It's part of the Fed's mandate. That's what we're going to focus on. But the data is generally mixed. And with changes to immigration and other policy, there are a variety of factors that could be distorting the labor market in unusual ways.
When you put this together, it sounds like, Andrew, there's a greater risk of upside to the economy, the idea of a reacceleration. There is some sort of downside, the idea that you could see a real further deterioration in the labor market. What's the implication of how far that can go? People have talked about bubbles. People have talked about already tight levels in credit. People have talked about the idea of a steepening yield curve. Where do you see the potential mispricing of such a reacceleration?
Yeah, so I think there are a couple of factors. So first, I think certainly for the credit market, the market that myself and my team follow most closely, of those two tails, the weaker growth scenario is, I think, the much worse tail than the more speculative boom scenario. That boom can take some time. And I think importantly, we're still, I think, in the very early innings of the type of M&A activity that we would expect if things really pick up. I mean, you're still below average in terms of levels of M&A adjusted for the size of the economy or adjusted for trend. So there's a lot further that can go. And I think for as much as we rightfully focus on higher levels of optimism, say, among retail investors, corporate optimism, corporate activity levels have not been elevated. And I think there's more room to go there. So companies that benefit from M&A transactions, some of those advisors, those are stocks that my colleagues on the equity side are more positive on. And, I also think kind of importantly, there are, this is a market that is still providing a discount to things that are smaller, more cyclical on the equity side in a way that's not true on the credit side. So, again, I think this dilemma that the credit market has is that if you believe that things could get a lot better, there are lots of small, cyclical, more levered stocks you can buy at large discounts. But in credit, we're often already pricing those things at 20-year, 30-year lows.
So, Andrew, are we at a space right now where the Fed is cutting into what you view as a reacceleration of growth?
So I think that there's a number of data that's suggesting that's a real possibility. And again, that it might not even be a reacceleration of growth, but just if growth holds up. Just if growth is kind of stable, then the Fed cutting into still above average inflation and rising inflation, the Fed cutting into these already easy financial conditions. And then I think also really importantly, the Fed cutting into what looks like a really historic boom in CapEx. The amount of spending that we at Morgan Stanley are expecting from the AI data center revival growth is just enormous. It's in the neighborhood of $3 trillion, we think, between now and the end of 2028. So again, these things might not be, 3% GDP type of numbers, but if the cycle can hold up for longer and extend for longer, there is this kind of dry tinder of potential for M&A, potential for more strategic activity, potential for more CapEx that could kind of heat up conditions in our view.
Stay with us. More Bloomberg surveillance coming up after this. Divisions on the Federal Reserve clouding the Fed's communication as Fed Chair Jay Powell is set to speak tomorrow. Krishna Guha of Evercore ISI writing the active debate for policy going forward will be predominantly within the 12 who see more cuts in 25, not the 7 who do not. Krishna joins us now for more. Krishna, welcome to the program. Let's just start with that division of the Federal Reserve. Just how material is it and how different is it to what we've seen in years gone by?
So I think we learned two things at the meeting just gone. First, that this is still Powell's committee. He can still muster majority support, particularly, although not disclosed, among the voting members, if you guesstimate whose dots are whose, for the policy path that he prefers. And that's market risk friendly because Powell is on the more dovish side of the committee, more preemptive risk management side. But there is this large block, 7 Fed officials, who don't see any further cuts after the September cut this year. So the question is, what influence will that 7 have on the debate? My sense is not that much. I think the debate will mostly be among those who see the need likely to cut rates further, but will be debating exactly the economic conditionality and cadence rather than that block of hawks. But you can't completely dismiss the 7 no-cutters.
Krishna, when you started talking about the Federal Reserve, you pointed out that this was Chairman Powell's Federal Reserve, almost like it was his committee. Is it too early to begin pricing a post-Powell Fed?
So I think the market, sensibly in my view, is looking at 2 different time horizons in a different way, right? Through the end of this year, indeed even through really at the end of Q1, early Q2 to the very end of Powell's term, I think Chair Powell will continue to drive the committee. I think there is a lot of loyalty to Powell, and I think that the divisions among the central group, while they're there for sure and amplified by these political strains, I don't think they're very, very deep. I think most of that core group would agree with Powell that you want to be stepping rates back to a more neutral setting, and that if the Labour side continues to look quite weak, you want to do that in a timely manner. So that's the successive September, October, December cuts versus perhaps if the data were to pick up, then you might slow down that process. Separately, the market needs to look forward through the end of next year and beyond and ask what might change under new leadership. And I think when you look at the market pricing through the end of next year, you very clearly put some weight on the prospect of a more dovish shift in the Fed reaction function as new leadership takes over.
Krishna, has this market adequately appreciated just how dovish this central bank already has been? The idea that they're cutting at the most aggressive pace going back to the 1980s when we weren't in recession. I mean, this is really an unusual type of paradigm given that inflation has remained above the 2% target for more than 4 years and is expected to remain above that for the remaining upcoming 2 years. I mean, at what point is this market not appreciating how hot this Fed is already running the economy?
So I certainly agree with you that this is a quite unusual set of circumstances. I think it's important to caveat that in two ways. First, the Fed is not cutting rates to, at least under Powell, is not contemplating cutting rates to what the Fed at least would consider stimulative territory. What they're talking about is removing what they estimate to be the remaining restraint in the economy. That's the roughly 75 basis points of restraint between where we were on the eve of the September meeting and a spot neutral setting that might be in the zip code of 3.5, 3 3/4, separate from where the long-term neutral rate might lie when things settle down to equilibrium, which many still see at the Fed as more like 3%. So you're talking about removing restraint, not providing stimulus. The other thing is, of course, you're seeing, I think, under Powell's leadership, and of course with pressure, intellectual pressure from Waller and one or two others, the Fed's taking a view that maybe they should be, at least to some significant degree, looking through that current elevated inflation, because it's to a large extent reflecting the pass-through of tariffs into prices. And of course, from a textbook sense at least, you want to look through that first round mechanical tax impact, if you like. It's a bit like a sales tax in that regard. And you want to be focused on where you think the underlying inflation dynamics are going, what risk there is of inflation persistence. And, you know, if you look at wages minus productivity, if you look at a lot of the services, particularly the more market-based services, you look at expectations, the news on that second round inflation dynamic is reasonably constructive. But I certainly still take your point that the Fed is cutting on risk management grounds into what may be the early stages of a cyclical reacceleration. I think the market is going to want to see more evidence on that firming in activity, and if it's passing on to a firming in the labor side too, before it really starts to trade that. But if you were to see that, then I think at a minimum, people would start to pay more attention, not just to these three cuts, but the prospect that when the next chair picks up the cutting baton, we might well be in danger of overdoing it.
Let's say the Fed cuts rates and long-term rates also decline. Will that help housing affordability? Will that help with this sort of declining trend in inflation that is hinged to the housing market, frankly, which has kind of gotten slack?
Well, so certainly I think if longer-term rates were to come down from here in an appreciable way, then obviously that would lower, the classic 30-year fixed type financing costs. And that would certainly help buyers at the margin. It might actually work a little bit more on price than on quantity in a number of cases, but certainly it would be good for housing stocks. I think in the absence of that, what we're likely to see is more people moving to fund at the front end through ARMs. Because, of course, as the front end rates, the Fed sensitive rates do come down, there's an opportunity potentially to finance at the front end rather than finance through the classic 30-year. I don't think that there is a huge amount of scope for 10-year yields to come down further from here if we are indeed in the early stages of at least cyclical stabilization and possibly even cyclical reacceleration. My hunch is if that's the path we're on, then the 10-year yield will be higher 6 to 12 months from now, not lower, and with it, of course, then those conforming loan rates. With respect to housing and inflation, I get the point you make, and it's a subtle one about the relationship between, home construction and ultimately, OER, rent, and those other housing services related components on inflation. I think that's right. I still think overall, though, higher longer-term interest rates will tend to restrict the economy in aggregate across all the sectors and put downward pressure on inflation, and vice versa if the 10-year goes down.
Stay with us. More Bloomberg surveillance coming up after this. Kelsey Berro of JPMorgan Asset Management writing the low-hire, low-fire labour market is keeping wage growth moderate, allowing the Fed to ease policy in 25 basis point increments over the next 2 to 3 meetings. Kelsey joins us now for more. Kelsey, good morning.
Good morning.
It's kind of the easy piece of this, potentially, the next 2 to 3 meetings. Then it gets hard.
Yes.
What's the call for 26?
Yeah, I think we're in a critical juncture right now as it relates to the direction for the U.S. economy beyond the next 3 months. So there's kind of two ways that this could break. On one hand, you have the labor market, which is clearly weakening. I think it's not just supply. I do think it's a demand. But you have growth data that remains fairly robust and guidance from corporate America that suggests a lot of optimism. So you have kind of two ways that can resolve. One way is that the growth data starts to catch down to the labor market data, and the labor market data is the signal. The other scenario is that the labor market data is about to stabilize. The Fed is going to cut rates. Easy financial conditions are already there in the background, and in 3 to 6 months, are you looking at companies that actually want to restart their hiring plans, continue their CapEx, and we could be looking at a Fed that doesn't need to cut rates anymore and an economy that is operating above trend. So right now we're sub-trend. I feel pretty comfortable with where we are now and the carry and credit we have in our portfolios, but there's still a lot of uncertainty about which way the economy breaks in the next 6 to 12 months.
What's the market pricing? Which way does the market believe that this economy is going to break?
I think the market is pricing that the economy is going to break more towards continued expansion and companies that after a period of pause start to reinvigorate their activities and start and that labor market weakness that we're seeing is temporary. And the way that I see that is I like to look at what the market is priced in terms of the Fed, and I think the way to look at it is you look at the median and you also look at the most hawkish and the most dovish. Right now, for the next 6 to 12 months, the market is priced somewhere between the median dot and the most dovish dot. So still reflecting the fact that the balance of risk for the Fed is more likely that they cut faster than they don't cut at all. But then, if you look at the longer-term trajectory for the Fed funds rate, it kind of looks like, well, we sometimes call it the Nike swoosh, because the policy path starts to turn up. And if you look at what the market is pricing for the long term, the market is actually slightly above the most hawkish expectation for the Fed funds rate in the long term. And that reflects some of that longer term optimism around growth prospects that has kept yields structurally higher in this environment.
So what you're saying is actually really interesting. The idea that long-term rates potentially could go higher in a reacceleration trend. What you're saying suggests maybe that's not the case. Maybe that long-end rates right now, as they are, even with yield curve flattening, are already pricing in that reacceleration. And actually, if you get some sort of real deceleration in the labor market, you get a bigger rally. Is that what you're basically leveraged to?
Yeah, I think that speaks to the asymmetry in the value and owning duration. So I would say that the path for the market is priced for the Fed in the short term is, priced fairly to the trailing data. But where we still see that there is valuation opportunities is in those long dated forwards where they are very elevated. They are pricing in a lot of optimism. And then on the other hand, a lot of people have been concerned about the structural supply-demand dynamics in the Treasury market. Are there going to be foreign buyers coming in? So far, we've seen that the demand for fixed income is there. The other concern has been around the mix of Treasury supply, and that's not even just a trend in the U.S. The long end has had question marks around it across most developed market government bond markets. And what we're seeing there is signs that debt management offices and the Treasury in the U.S. are actually probably going to be more active in terms of shifting their issuance to where the demand is, which we see still in the 5 to 10 year belly of the curve.
Kelsey, can you give us some more detail on that? What has the Treasury been doing more recently that's enabled this market to reject the supply fears? What have they changed?
Well, they haven't actually changed anything. It's about market sentiment around those things. So one is that you've seen very strong auctions generally. There's been a few exceptions. There was a pretty poor TIPS auction last week, but generally the nominal auctions for the long end have gone very well. The other other thing that has shifted in terms of perception is, now we have the roadmap for fiscal. We have the one big beautiful bill. We kind of know what we're going to be collecting in terms of tariffs on an annualized run rate. And we can kind of feel at least more comfortable. The deficit trajectory isn't great, but at least, we know where it's headed. And then, while the Treasury hasn't done anything dramatic, they are doing buybacks on the long end. And we do think that over time, they will be able to keep the long end supply stable, if not maybe shrink it as a share of issuance. And you'll see the bill issuance as a share is going to actually be able to rise a little bit.
Stay with us. More Bloomberg surveillance coming up after this. Venu Krishna of Barclays writing, we've increased our year-end 26 price target to 7K from 6,700. We expect US tech valuations to continue reflecting constructive investor views. Venu joins us now for more. Venu, good morning. It's good to see you, sir.
Good morning, John.
So an upgrade to the outlook. Let's start there. What's underpinning that view at the moment for you and the team?
Couple of things. First, the first half has been much stronger than what we expected from an earnings standpoint. Two, if you dig in and see what's driving that, it's tech and financials, which is over 50% weight of the market. And the revisions for that actually are improving. And now we're on the cusp of rate cuts, which incrementally are, of course, positive for the market, right? So I think when you put, and then don't forget that global growth, if anything, is stabilizing. And US will exit this year, economic growth, by our economists' estimates, closer to around 1.8%, 1.9% range, which is pretty healthy. So I think while there's a lot of talk about, valuations being extended, which I don't necessarily agree with, but right now, if you see what is holding the market, it's three things. One is the AI narrative is still very much intact. Two, we are in the cusp of Fed cuts. 2, 3, let's see what happens. And 3, we are entering a period of strong seasonality. Now, that's more of a technical sort of phenomenon. But that said, we do believe that all that is priced in, and I have a hard time seeing how the market can keep grinding higher. But then if you look past this year into next year, we do see earnings improving 10%, and we do see the market going in the range of 7,000 to 7,800. That's an upside and base case range.
Let's break it down. Yeah. Earnings and valuations. Yeah. Just want to sit on valuations just for a moment. You said I disagree, they're extended. Yeah. So tell me the source of that disagreement. Yeah, so I think the tendency is to look at the aggregate multiple, which by historical standards looks high. One is, we've done work and it shows that over the last 15 years, there's a structural increase in multiples for S&P, and this is primarily a function of the domination of tech, which has been faster growing, higher quality earnings, better margins, and higher multiples. So that's one. But the other thing we do is you got to unpack the market, and we take a sum of the parts approach. In other words, we look at big tech, rest of tech, and rest of S&P. So if you look at big tech, it's trading right now at about 29 times, right? Looks high, fine, it is true. But it started the year at 31 times. They posted earnings of about 28%. They increased their their net margins by over 200 basis points. They beat numbers by 11 to 12 percentage points. That's one. Rest of tech is trading around 28 times. Now, that's a tad high for rest of tech, but if you remove some extreme names like your Palantir, those sort of highly valued names, it's more reasonable. And in fact, the software part of it has got sold off because of a lot of concern about AI disrupting the business model. So we, in fact, think there's an opportunity there. And then last portion, the rest of S&P, which is called broadly 60% of the market, we really see it as a function. We have a good model for that, which is a function of where rates are, where inflation is heading, economic growth. Based on that, it's trading around 20 times. That's fair value. Remember, just a few months ago, the 10-year was at 4.5%. Now we're struggling to to hover around the 4% range. So I think that's the reality. So in other words, I'm not suggesting it's cheap, but I'm saying it's not a rich market. It's a fully valued market.
How predicated is this call on further rate cuts by the Federal Reserve on the idea that yields have peaked and are headed downward?
It's not predicated on that, but it's supported by that, right? Because earnings are also improving. So we do see earnings actually improving next year. Not a lot from this year, but call it around 10-ish%. But where the 10-year absolutely happens, that fair value I talked about, that that definitely gets impacted by the way the 10-year is. You're always concerned about the correlation of rates and equities. And I think what we have found is that we get worried when the 10s breach 4.5% and start heading towards 5%, but there's a very distinct negative correlation we've observed over a very long period of time. On the flip side, when rates are already low, then you're concerned because of the destabilizing impact of deflation. Right now, we're in a sweet spot where we have some amount of inflation, which is not necessarily bad, which actually strengthens the ability to do some pricing on the pricing power front. We have economic growth, which is moderating compared to 23 and 24, but still relatively robust. And you have corporate earnings which are very strong. And most importantly, what has happened is the tariff effect, which even we estimated, has proved to be a little less worse than what we thought. It probably got pushed out a little bit, but companies are figuring out, and most importantly, based on the transcript work we have done, it appears that in their guidance, they are already taking into consideration the mitigation steps. And so the guidance is relatively safe at this point.
This is so much optimism, I can't even stand it. I will just take one issue. This idea of seasonality. Yeah. Everyone said that September was a bad season. It's always a bad month. Well, we're up more than 3%, and it's poised to be the best September going back to 2010. Has seasonality broken?
Well, in the recent years, it has. Even last year was the same story. August and September was pretty good. Historically, it's bad. But I would argue that why just seasonality now? Everything is long-term relationships have broken quite significantly post-COVID. You have a negative yield curve for a long time, inverted curve. Did we have a recession? No. We had PMIs in the negative territory. Did we have industrial recession? No. Did earnings collapse for industrials? No. Right? But it doesn't mean they're not risks. So a lot of relationships which we thought existed are simply not true. Right? And it doesn't mean that you shouldn't worry. It just means that, if you say this time is different, you got to take it in blocks and see, what next. And so right now, at least for the next 12 to 18 months, we don't see significant catalysts for destabilizing where we are right now.
So do you find policies like H-1B visas, the tariffs, they're still being legislated in courts when it comes to IEEPA? Do you find DC policy supportive, or are they headwinds next year?
No. I mean, one of the biggest concerns this year has been the level of policy uncertainty. But what is amazing is that the market has learned to look past it and to see, the extent of rhetoric, how long it lasts and goes on. I mean, you saw even the H-1B thing. We had data shifting over the weekend, right? First, the news was more draconian, and then they came back and clarified that, it's one time and it's not for renewals and things like that. So I think policy uncertainty is something we have to learn to live with. What we have to watch out for, where it oversteps acceptable boundaries of the market, right? And so that's where I would actually watch the rates market more for that, to see if and when the discomfort is there. I mean, to talk about deficits is the biggest concern right now, right? And what is your 10-year doing? It's down. It's not up, right? So term premium has actually come down. So I think you start looking at those things and say that to what extent is the magnitude of policy uncertainty going to hurt the market? And so far, I think it's a risk, but it's not an overwhelming risk thus far.
Venu, what's amazing is what you said about earnings for next year, EPS revisions. It's been a huge focus of this program for quite a while now, that we've had this step down in payrolls growth, massive step down in payrolls growth. And maybe it's been building for a whole lot longer than people realized. And yet you're still seeing this step up in earnings revisions, which makes me wonder just how relevant this is, which is an uncomfortable conversation for anyone following this right now, sitting at home saying, well, it's relevant to me, it's relevant to everyone, everyone needs a job. But at the moment we're seeing that tension just grow, get bigger and bigger. How relevant is the payrolls number to the broader market and to earnings?
It is relevant. And that's why talking about, this market is highly bifurcated. That's why I said if you look at where the earnings strength came from, it came from just two sectors, tech and financials. And that's where the divisions have been. If you looked at the rest of the 8 or 9 sectors, 90% of them had negative operating leverage, in which their cost growth was faster than the sales growth. So we should not lull ourselves into thinking that everything is hunky-dory across markets. It's not. right? And that's where we're paying attention. That's why even in our outlook, when I take the sum of the parts approach, we're a lot more bullish on the tech front, and we are very positive on financials. But compared to consensus in the street, we're a lot lower on the rest of the economy. So, how does the rest of the economy get impacted by all this is important. And to your point about the labor market your tech companies are laying off people by the thousands, but their net margins have improved by 200 basis points, and their earnings are off the charts. And on a PEG ratio basis, when you say things are rich, it's kind of 1, and the range is 1 to 1.6. So what are we talking about?
Do you think the tech sector can continue just to trade on an island? It can just be its own beast, this big secular theme that's detached from the cyclical story? Or do you think when they do finally face a cyclical test, people might be surprised by just how resilient they might not be?
Well, they will face a cyclical test. It's not happening in the next 18 months, and we're doing more work. Look out for that.
Sure.
We're doing some excellent work on that. But the interesting thing is the tech's impact now is spreading across a wider cross-section of the economy. So, for example, when you talk about even big tech and all the CapEx spending, it is not just the big hyperscalers right now. It's gone into utilities. It's gone into component manufacturers. It's gone to industrials. So it's spread. So to the extent that tech is negatively impacted in terms of the scale of the business, it'll percolate to some extent. So yeah, it's a mixed bag. But look out. I think probably we should come back and talk again.
Well, I'll look out for your research piece. Before you go, we really wanted to squeeze in your view on small caps.
Yeah.
We've had this massive rally. You've talked about the lack of broadening out for earnings revisions. Small caps have rallied almost exclusively on a re-rating of the rate cycle, the rate cuts, the repricing of that over the last, let's say, 2 months, since early August when we first had that really weak July payrolls report. Are you seeing anything beyond the rate cut story to justify the rally we've had over the last 7 consecutive weeks?
For the first time, we are. And let me paraphrase that we've been negative on small caps for the longest period of time, right? And it's not worked for the last 2 decades. I still am very skeptical. I think it's more of a rental trade or a tactical trade rather than a long-term strategic trade. The reason I say that is, yes, rate cuts have been one of the huge booster for them. But if you start looking at the SML, which is the more profitable portion, 400-odd companies from the Russell universe, we were surprised to see that they actually had some modest sales decline, but managed to post pretty solid earnings on top of that. And their revisions have improved, and actually their revisions have gotten slightly better than the S&P outside of tech, that portion. So I think there is some fundamental strength which is going consistent with the recent rally. I just worry how long it's going to last, especially for things like tariffs, which have not fully shown yet. I think it's going to percolate over the next few quarters. Business-wise, there's less flexibility. The other thing is, with the 10-year coming down and front-end rates coming down with a lot of floating rate debt, they do benefit in the short term.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.